And we have completed our syllabus. We know we have 8 chapter or 8 module, and last class we have completed it. So today we'll discuss few items. Here, one market value, book value is here, market cost is here, and this from this what will calculate from capital structure of weighted average cost of capital based on the book value and market value. So here is a calculation. You can see it is one is market value, and we have to weight it. How we weight this one? This total market values come 119,220. So 119,220 if 1, then 65,740 is 0.551. So this way calculate this, and also the book value. Total book value as given in the question 82,000. So 82,000 if considering 1, then 32,000 is 0.390. So this way calculating this, and cost is the fixed here as per the question 8.5 for the debt, 10.6 for the preference stock, and 25.3 is the common equity. So if multiply with this one for the market value weight and with the cost, then we get the factors market 3.5. So after calculating market, total here comes 17.94. And same way in the book value, if we multiply 0.488 with the 8.5, then we'll get 4.15. So this way calculating 15.31. So weighted average cost of capital here come 17.9%, adding this 3. And also 15.3% for the book value. So this one. Another one, capital budgeting question, is a 19 number question. So your solution is here. You see it in own side. And another question is the probable question. That means it can be 20 marks this way. Look here, FY has been making a constant annual dividend payment 30 million. The finance committee of the company has decided to reduce the current year dividend obligation by 20 million to fund list of the following 3 projects. Here also 3 projects. Project investment, head office investment 15 lakh, that is 15 million. Investment in project 10 million. New branch opening 5 million. So here NPV in million calculated here. All this is the figure for NPV. So by this way they calculating here which project you should accept. So here is the calculation. So here investment in million, NPV, and here we calculate here's profitability index, and based on profitability index you ranked it which project you should accept, 1, 2, 3, this one. And also it is the what is this? So how we invest in here, 2 things. One, as a company secretary FYI determine which project should be undertaken in order to maximize the return of FYI shareholder. So this one would be the maximize. You should accept which one, how you will maximize. So number 1, your fund is 20 million. You just ranked it which project is the number 1, giving your NPV based on the profitability index. So we know the profitability index, how we calculate is, if we look here present value, that means here NPV, net present value. So from if we 15 plus 6.50, so 15, that means if present value, then that would be 11.50, because is the net present value, N net, minus the initial investment. So calculating this from 1, P comes here, that way the rank is here. And we have the 20 million as per the question for investment. How we invest it? because dividend obligation by 20 million to fund to at least one of the following three projects. So dividend payment obligation was 30 million, and from that 30 million, 20 million for the investment and 10% dividend they distribute for the capital investment. So this 20. So head office is required the 15 million. And here net present value earning is 6.5. This one. 6.5. If we invest in head office, we have 20 million, but head office require 15 million, and project investment 10 million, branch 5 million. So based on rank, first you take this one, head office. Now comes your investment in property. But investment in property, here you require 10 million, but you have only 5 million. So here condition is that this investment we can take proportion or partial. For example, we have $5 million, but our investment require 10 million for the properties. If it is allowed for 50% investment, we are thinking that 50% can be invest, partial can be invest. So if we take this one, and we have to put a note also for that investment, if 50%, that means 5 lakh. It's 5 million, sorry, 5 million. So we invested total 20 million. We have no available fund after investing the property 5 million. So from that property, we get the NPV. Their NPV was 4 million. So if we invest 50%, so NPV also 50% we have to add here. So 50%, that means 2. So total NPV comes 8.5. This is the highest return if invest head office 100% and 50% property, then total highest NPV will come. So this is the answer of number 1. As a company secretary, you should recommended that have to invest head office 100% and investment property 50%. By this investment, we'll get proper, that means highest NPV. And describe 5 factors that could have inflated director's arrival dividend amount to be paid. So here the 5 factors is a net realizable profit, a long agreement, inflation capacity, company liquidity, gearing level, and significant, that is the theoretical. And can you estimate the value of the FIR using the dividend valuation model? So based on that, you have to calculate the valuation of that company based on the dividend valuation model. So a dividend valuation model, this is the formula for dividend valuation model. Value of the FIR using the dividend valuation model, this one. So here calculate the asset beta, and here equity beta, beta E, market value of company's share, VE, market value of company's debt, PD, and market value of company's share plus debt adjustment with the tax, because here debt interest have to adjust with the tax. So after tax market value of the company, T, that means company's tax rate. So based on that, putting all data here, then we will get this one, 107.8 million. So this within this formula calculating here. Look, this one is your exam in CS exam in July 17. Is the chapter of corporate restructuring. It was 8 marks. Look here. A limited wants to acquire T limited by exchanging 0.5 of its share for each share of T limited. The relevant financial data: earning after tax, A limited 18 lakh, T limited 3 lakh 60,000. Equity share outstanding here 6 lakh and T company 1 lakh 80,000. EPS A limited 3, T limited 2. Price earning ratio 10 times A limited and 7 times T limited. Market price share per share at this moment, A limited 30 taka, T limited 14 taka. So here requirement is that 5 requirement, very small requirement. What is the number of equity share required to be issued by A limited for acquiring T limited? A limited wants to acquire T limited. So what is the exchange? That means 0.5. A limited wants to acquire T limited by exchanging 0.5 of share. So its 0.5 share have to issue. It's mean that T limited's 2 share equal to A limited's 1 share. So here, what is the number of equity share required to be issued by A limited? So look here, the very simple, and that's why marks is 8. So here 5 calculation. Number 1, number of share. T limited have 1,80,000 share and conversion is 0.5 share of A limited. So 0.5 multiplied by 1,80,000. So 19 number of share have to issue for acquiring T limited by the A limited. It's okay, clear. Only 90,000 share have to issue. Number 2, what is the EPS of A limited after acquisition? After acquisition, all belongs with the A limited. So earning after tax of A limited and earnings after tax B limited, it should be accumulated because the owner, that means all items owned by the A limited, because the A limited acquired T limited. So both profit, if we add here, look here, both profit 18 lakh plus 3 lakh 60,000 and divided by number of share. Which number of share? Here 6 lakh is the previously, originally A limited have the 6 lakh share and another issue 90 lakh and 1000. So 6 lakh 90,000 share is the now. So total 18 lakh plus 3 lakh 60,000 earning after tax divided by number of shares 6 lakh 90,000. So EPS is 3.13. Look here, previously its EPS was 3 taka. But after acquisition, increase the EPS from 3 to 3.13. So is the achievement. Now determine the equivalent earning per share of T limited. Now T limited earning per share have to determine. T limited previously earning per share was taka 2. And what happened after the acquisition? Look here. So equivalent EPS would be 3.13 divided by 0.5 because exchange what 0.5. So now once the value of the EPS of share that multiplied by 0.5, then equivalent EPS is for the company T 1.56 taka. That means below than their previous EPS. Now price earning ratio, that was 10 times, and if we see that D, what is the expected market price per share of A limited after the acquisition? after the acquisition, what would be the expected market price per share of A Limited, assuming its P multiplier remains unchanged. So here P multiplier, here 10, here 7, it would be unchanged. What would be the expected market price of A Limited? Now, if we go here, expected market price, that means its earning per share 3.13 taka multiplied by unchanged multiplier of PE, then it's come 31.30. Expected market price per share is 13.130. Look here, market price before acquisition it was 30, but after acquisition market price increase 31.30. Now determine the market value of the Mars firm. So what market value of total value of the firm? So look here, if expected market price of per share 31.30, if we multiply by market total number of share that issued 6 lakhs previously and 90,000 issued for the acquired of the company T. So if we multiply 6 lakh 90,000 share number of share with the expected market price 31.30, then market value of the firm after acquisition 2 crore 15 lakh 97,000. So is the very simple, but sometimes after seeing the math, then we will be puzzled how we can calculate is. It is different types of calculation, lot of requirements. But look here, if we think very coolly, very easy, just a logical thing here. And also that math can be only can calculate, determine the market value of the firm. If just this question, determine the market value of the Mars firm, then you have to calculate all things. The answer will be just one thing, this one. So this one, look here, another math. It's also in July 17, is chapter, also the corporate restructuring also here, 12 marks that was. So look here, 12 and 8 is the one question here. Here to company is here the exchange, different types of exchange, net asset value, earning per share, market price per share. So all calculation is here. Is taken from a book also. Probably that was Khan and Jane or Pandey maybe, from that books that taking the who just as same as the question. And another look here, CS exam January 19, 5 marks only. And very simple, a company is expecting to declare a dividend taka 3.5 per share during the next year. Investor forecast a dividend of taka 4 in the year after that, taka 4.5 in the next year. Thereafter, it is the expected dividends growth 10% into the infinite future. For the future, the investor rate of return is 20%. What is the maximum price that an investor should pay for the share? So investor should pay for the share maximum price. The calculation is here. This way, after calculating, investor may pay this one 14th. So another one is also in July 17. Marks, look here, a big question is come in July 17. And as same as taken from books, answer is here. Just for your another one, July 17, planning working capital. It comes from the working capital, 20 marks. So from this is not so easy. This one here, 2 years calculation was generally that type of math not come in the CS, but that year is come here. Look at year 1, 2 calculation. Look here, this is the very much complete that was all calculation here. I also take from the book also. Answer is there. Look here, big math. It was your 20 marks. So it's that type of question. Another one, January 19, 10 marks. And also solution is here. January 19, another 10 marks. Solution, question 5, C, 10 marks. Answer is here. Same way CISA July 19, 10 marks. Solution is here. So this one is the actual question from this question taken from a book. This question just few rectified, few after modified, the just few item modified, and then given in our question CS exam July 19. But that real question is that one. July 19, 12 marks. So here, look here, two companies, B and S, which so that earning EPS, market price, number of share calculate, just taking this one. So here, solution is here. You just take this one. Another question, credit policy. Is a nice question here. A small size. It is the 101 number math. FI Limited currently has an annual turnover 20 lakh and an average collection period 4 weeks. The company proposed to introduce more liberal credit policy, which they hope will generate additional sale as soon as below, as shown in is below. So proposed credit policy, there are 4 credit policy. Collection period 2 weeks, but present is 4 weeks. That means increase collection period 2 weeks, and total would be 6 weeks. And a sale increase this one, percentage of default 2%. So this is the 4 item, proposed item. It's all increase with the present scenario. The selling price of the product is Taka 10 and the variable cost per unit Taka 7. The current debt is loss 1%. And the desired rate of return of investor 20%. For the purpose of the calculation a year, we have to take 12 weeks a year. Okay. Indicate which of the above policy you should recommend it for the company to adopt. So this is the, if we see the right side, this is the calculation. Here 4 policy and existing ones. So we have to take 5 policy. This is the current one. Here 4 weeks, and the new one 4 plus 2, 2 weeks. Here 6 weeks. Then 4 plus 4, 8 weeks. 4 plus 6, 10 weeks. 4 plus 8, 12 weeks. So sale here saying that sale increase 2 lakh. Presently 20 lakh. So here 22 lakh. And then 2.5 in the 22.5. This way calculating. This is the sale. Here incremental sale in the second line. And then incremental contribution 30% incremental sale. Incremental contribution here 30% of sale. So production 10. So variable cost 7. So contribution is 3. So this way calculate, and after calculating all thing here is a percentage of default is a 1%, the present, but it would be 2% in the policy number, new policy number proposed, new policy number 1, 2, 3 this way. So taking this one, all cost calculating, the incremental return would be 22.5, this minus. So the incremental return is maximized if the credit period allowed 6 weeks. This is your recommendation. It would be your recommendation here. Allow 10 weeks, then it would be the minus. And 12 weeks also more minus. So this is the ideal would be 6 weeks. So you should recommend it for 6 weeks debt balance. Another one in NPV calculation. Calculate the NPV project. Here calculation, and another new math include sustainable growth rate. FI has annual sale 30 lakh and the equity capital 12 lakh. total debt 8 lakh, two mutually exclusive proposal are under consideration. Proposal 1 and proposal 2. Two proposal consider for the next year. So here, new equity raise 1 lakh, proposal 2, annual dividend in 0.3, target retention ratio or earnings here 0, here 75%. So this is the two proposal in the two figure, two side. Calculate the sustainable growth rate, both the proposal. So here is the calculation. Sustainable growth, that means here sale given, total asset. So all calculation here, you put it in your khata, and we will be able to discuss this if any difficulty comes. So also we have, for example, January 18 in your exam, question is here, and all solution is also here. I will give you that full set, and this way I am trying to calculate solve the all problem and taking a book also, but due to time constraints I am unable to take it. The January 19. So is this your CS question, and here model solution I have just ready for you. I will give you the full set just for understanding, and just okay with the theory to total thing here.